When you understand stock market history, you can understand where we are in the cycle. And if you can understand where we are in the cycle, you can make more money. All right, guys, what I want to do is I want to look at the stock market from 1980 to 2000. And there's a very specific reason why I picked this 40-year period. So we're going to A, talk about why I picked that period. B, let's look at what the crashes did and what the gains did. And then maybe I'm on D now. D, what you can learn from it from that cycle going from peak to trough. Okay, so number one, why 1980 to 2020? So a couple reasons. One, in 1981, the 401k actually started getting used. Now, the 401k is a way that a company can have the employee put money away for themselves in a tax-deferred way. Now, before this became popular, and it didn't become popular in 1980, but it started being used in 1980. Okay, before that, basically, pensions took care of everything. Before specifically 1981, but before 1981, the company you worked for would take care of everything. You didn't even need to know how to grow your money in the stock market. You just worked for Bell Labs for 30 years and they would take care of you, as an example. But that is not true from 1981 until present. So really, kind of the modern day of investing started at the very beginning of 1980. Now, there are some things that changed before 1981. The 401k was actually invented in 1978. There were some laws changed in 1974, blah, blah, blah. You're already losing me. The point is 1981 is a key date. Okay, so let's just talk numbers. That's why we're going to go 81 to 2000. Okay, let's just talk key numbers here. There were 5 crashes. Now, I don't really like using the word crash, but I'm going to use it here. So my definition of a crash is when the market closes down more than 21% and stays down for a prolonged period of time. A period of time long enough to scare the bejesus out of you and to really scare people over the age of 50 or 60, and they start contemplating, how am I gonna make up for this? How am I gonna make up for this, right? So really, it's only until we get over or below negative 21%. I think I kind of flipped that around. Until we get worse than a 21% fall that I'm measuring. Anything between a 1% fall and a 20% fall, it's noise. It happens a lot. And because of all the social medias and because everything can be measured today, people are just getting the crap scared out of them because every little move is being measured. And then these scary headlines go with the smallest of small moves. So we only care about over that 21%. Okay, so there were 5 of them. All right, I'm just going to list them for you. 1981. We had one. 87, we had one. 2000, we had one. 2008, we had one. And then we had one in 2020, which reminds me, I'm talking about the US stock market. So there's 5 major corrections. Now, the average fall of those corrections was 40%, 40%, right? So if your $100 goes down to $60, that's the equivalent of losing 40%. It's a pretty big deal. The worst fall was 58%, and that happened, that got a name, the global financial crisis, 58%. From peak to trough, that took 18 months, which is actually a pretty short time for a 58% fall. The fastest fall ever was the COVID crash. That lasted 30 calendar days or 20 trading days. That was down 34%. Okay, other interesting things. The time frame, this is really, and this is a key thing I really want you to understand. The time frame between the peak before it crashes, so think like 1987 before it fell, right? And then that was only about a 3-month fall. Interesting, right? I'm also telling you the time frame of when things fell. So in 87, that 33% fall happened over 3 months. Up to that point, that was the shortest ever. What I'm talking about, time from peak to peak. So the peak before the market fell in 87 to 2000, or I might have to go 87 to 2000. So here's what's interesting. Once a market peaks and then it has its crash, The next time it peaks on average is almost 10 years. It's literally 9 years and 9 months on average. Now, the shortest between those two was 5 years between peak to peak. The longest was 13 years. So let's say we go back to February of 2020. And the shortest time over the last 40 years from peak to peak was 5 years. So let's see, February 2020, 21, 22, 23, 24, 25. So the shortest would be the next market peak we'd have would be February 2025. As an example, just to give you an idea of what 5 years looks like. Now, the reason these cycles, and I think of them as cycles, are important is because after each crash, I'm not laughing when people lose money. It is not funny. But what is very interesting is the amount of people calling for a crash after the market crashes exponentially goes up, right? So after the 2008 global financial crash, guess what? Now, it ended in March of 2009, okay? Guess what people were doing over and over and over again? It's going to crash again. 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 That keeps people out because they don't know how to read price charts, right? When you understand how to read price charts, you can actually look at the market and go, yeah, but it's not crashing. Now, the '08 crash, which is what I'm calling it, actually peaked in '07, but almost no one knows that, right? So it was actually October '07. That was the top. And then the bottom was March '09. But I just want you to hear the average time between peak to peak is actually 9 years and 9 months. I'm going to round it to 10 years. So that tells us that there's time after a market crashes. Now, I've studied market history. I've been investing myself for 35 years. And what I've noticed, and I just told you, but I want to kind of riff on it a little bit more is, well, actually, I want to talk about it from a different point of view. The steeper the fall, or the faster the fall, right? So if we go from losing 34%, and let's say we lose 34% in 20 trading days or 30 calendar days, which is what happened in the COVID crash. What I've noticed is the faster the market falls, the quicker it rebounds, right? So a 34% fall in 30 days is probably equivalent to a 50% fall over a year and a half. The 49% fall, the dot-com fall, that took 30 months to fall 49%. The global financial crisis took 18 months to fall 58%. So there's this rough correlation between how steep it falls and how fast it falls and how painful it's going to get. Now, I said I was going to talk to you about the cycle. So understanding the cycle and understanding where we are in the cycle is really important, right? So if you're watching this video in 2025, February 2025, you can go, oh, wait a second. The fastest correction ever between peak and peak was 5 years. The longest was 13 years. So it could be anywhere between now and 2033. If I'm doing my math right. If not, it's 2032. The average one is 10 years, which could be 2030. So the cycle, the time between those matters. And I really want to iterate this again and have you hear it's like, oh my God, RC, you're telling me now a third time. Once the market crashes or falls, all right, anything over 21%, the scaredness, the anxiety, the stress, the worry, the overwhelm is only going to increase, especially if you don't know how to read price charts. Because when you read a price chart, the price chart's telling you what is actually going on. Otherwise, you're just going to be really scared. So every time there is a market crash, if you don't like the word crash because it's too triggering, call it a drawdown, call it a correction. But the big thing to take away from this video is corrections happen, crashes happen. Anything under 20%, which guys, I understand, you don't know it's going to be under 20% until after it happens. And it's officially not over until it breaks out to a new lifetime high. But mostly from this history of the stock market, just go, okay, the US, most of the world really started investing in 1980. Before that, almost no one invested. Even in the 1930s and the 1920s in the United States, almost no one was investing their own money. There weren't a lot of people in the United States that had money in the market, but the ones that did got absolutely taken out. And guess what? They were the richest ones in the country. No different from today. But the most important time period of the stock market has been from 1980 forward, because that's when people have really been in charge of managing their own money. Pensions have dropped almost to zero, of course, not to zero. And really, people are in charge of managing their own money now. So cycles matter, and understanding stock market history matters.